As a CEO or CFO, your time is precious, and every decision you make must be grounded in financial reality. Imagine this: you are sitting in the board meeting. You don't have hours to dive into detailed reports. You need to know your company financial health immediately. Here's the thing: you don't need to go through spreadsheet or complex financial models to get clear picture. By mastering just two key financial statements, the balance sheet and the income statement, you can quickly assess your company's strengths, weaknesses, and overall profitability in minutes. In this video, I'm going to show you exactly how to do that. You will learn how to focus on assets, liabilities, equity, revenue, costs, and profitability. With this, you can confidently make strategic decisions that move your company forward. By the end of this video, you will have the knowledge to perform a rapid financial analysis that tells you everything you need to know. Let's start by the balance sheet, which is offer snapshot of the company's financial position at given moment. It includes three main sections: assets, liabilities, and equity. Understand the breakdown of these components is crucial for evaluating the company's financial health, liquidity, and solvency. In this analysis, we will break down each key balance sheet item and assess what it reveals about the company's current situation, including cash balances, current assets, liabilities, and equity. We aim to assess liquidity, short-term financial stability, and long-term financial stability. So let's start by the assets. So the first thing that we need to look is the current assets. We have a total current asset of $500,000, which represent around 80% of the total asset. There are the resources that the company expects to convert into cash or consume within a year. Analyzing each component give insight into the company liquidity, operation efficiency, and financial flexibility. The first thing we have cash and cash equivalent with a total amount of $240,000, which is the most liquid asset. It's around 8% of the total asset, which represent a strong cash position that ensures that the company can meet its short-term obligation. If you look to the short-term obligation, we have $210,000. If you compare that, you see that with the cash that the company has can meet their short-term obligation. We will discuss the current liabilities. So maintaining too much cash could indicate underutilized resources. The company should assess whether to invest this cash into higher yield investment, business expansion, or paying off debt. Now let's look to the account receivable. Present 24% of the total assets, indicate a healthy balance of the sales on credit. While offering credit term can boost sales, it's crucial for monitor receivable to avoid cash flow problems if the company experiences slow collection. Second thing to look is the account receivable is to compare it to the total revenue for the year. We have 580,000 as revenue. So this is indicate the average payment for the customer is 90 days. If we estimate the last quarter, what we have billed to the customer is not yet paid. So this need to ensure that the company has to enforce collection strategy and to make sure to reduce this amount of the account receivable. It should be reduced to at least 100,000. Now let's look to the third part in assets. We have inventory. It's total amount 100,000. So inventory is around 16% from the total assets. The company holds goods available for sales, but managing inventory efficiency is a key to balance customer demand and cash flow. So a high inventory turnover ratio would indicate that inventory is sold quickly, filling up working capital, and excess inventory may indicate weaker than expected sales on influence supply chain management. The goal should be to maintain a lean inventory system, minimizing holding costs while ensuring adequate stock level to maintain. So we can compare the inventory level 100,000 to our cost of sales. So the monthly cost of sales, we can divide this value divided by 12. So it's around 20,000 per month. That means with 100,000, the company has stock for around 5 months. It should be lower, but because the company has cash and cash equivalent, so it's not bad to keep this level of inventory or have stock when the customer they need it, so we can deliver to the customer quickly. So again, inventory 100,000 represent high amount, which represent compared to the cost of sales. So we need to reduce it in this case in order to make sure that a healthy financial statement. However, because we have a high cash and cash equivalent, so it's acceptable to maintain this high level of inventory. And we have prepaid rent, which is 10,000. This is a small part of the current asset. It's around these reflect payments made for rent in advance. Now let's look to the second part in the assets, which is the no current asset. So the total no current asset is 130,000, which represents 21% of the total asset. These long term assets, primarily property, plant, and equipment, support the company's operational activity over the long run. So it's a total 330,000, signifying a significant investment in the company's infrastructure. Property, plant, and equipment represent 52% of the total asset without reducing the accumulated depreciation. So reducing the value of the property, plant, and equipment reflect the wear and tear of those long-term assets. The net book value of property, plant, and equipment after depreciation is 130,000. High depreciation can be sign of old assets which may soon need replacement. The company should evaluate whether additional capital investments are needed to modernize equipment and improve productivity. The total assets for the company stand at 630,000, provides a snapshot of the company's available resources. The company maintains a strong balance between liquid asset and long-term investment. To better understand how efficiently those assets are being used, the company should calculate return on asset, which measure how efficiently assets generate profit. Now let's look to the other side, which is liabilities and equity. The current liabilities represent 33% of the total asset. These are obligations that the company must settle within the next 12 months. The account payable for 150,000 represents 70% of the current liability. These reflect amounts owed to suppliers for goods and services received. The company should take advantage of favorable payment terms to maintain a healthy cash flow. The salary payable, we have 20,000. This is a small amount, small portion of current liabilities. The income tax payable reflects the tax owed to the government. The company should ensure timely tax payment to avoid penalties and maintaining good standing with the tax authorities. We have 20,000.
This liability arises from services paid for but not yet delivered. Unearned revenue is a future obligation indicating future work commitments.
Non-current liabilities, we have 50,000, consisting solely of long-term debt. Amounts account 8%, around 8% from the total asset. A long-term debt is manageable, given the company the ability to finance capital projects with the company debt to equity is low, around 0.14, which reflects a conservative financing approach. While taking on debt can fund growth, maintaining a reasonable level of debt is important to avoid undue financial risk. The total liability is 260,000. which represents 41% of the total asset, reflecting a balanced mix of debt financing. The company overall liability level is modest, reducing the risk of insolvency and allowing for flexibility in future financial needs. Now let's look to the shareholders' equity, which represents 370,000. This is the residual value when from the asset minus total liabilities. The common stock for 200,000, which is represent the initial capital contribute by shareholders. These make up around 30% of the total assets, providing a solid foundation of the company financial stability. The return earning for 170,000 represent 27% from the total assets, reflected cumulative profit. If we look to the financial statement, in the income statement, we see the same amount reflecting here. So that means the company showing here only the profit for the last year, and the previous year it was paid as dividend to the shareholder, which is a good sign for the company that they are paying the dividend to shareholders. Now the total liabilities and equity is 630, so which is matched to the total of assets. So the company balance sheet present financial stable entity with strong liquidity, as we have seen before. Look into the cash, which able to pay its current liabilities. Now let's discuss the income statement for the company. So we have revenue net sales for the year 508. Last year it was 500,000. That's mean or notice that there is a growth of around 15% in this year. This is a strong indicator that the company is successfully expanding its operation. This increase could be driven by various factors, such as market expansion. It can be also product diversification or increased demand for existing product or services. If you compare the total assets, which is 630,000, to the total revenue for the year, which represents around 90% from the total assets. This indicates that the company is generating almost $1 in sales for every dollar of assets, which is reflecting efficient use of resources. We have also the cost of sales, 250,000. The last year it was 230. There is an increase around less than 10%. And it's mainly related to the increase of sales, that the sales it's increased by 15. Here we have group cost of sales increased by 8%. So this is a good sign that we are making more profit. And of course, when we look to the gross margin, we see that in this year we have 7%. The last year it was 4%. That means there is a good indicator. Is increased. The company gross profit has improved from 54% to 57%, reflecting strong control over direct costs. As we have seen before, that even we increase the sales by 15%, our cost of sale is increased only by 8%. Now let's look to the SG&A. We have value of 150,000. The last year it was 145. There is an increase for 5,000. The reason is there is increase of revenue, but if you compare the increase, it's very low compared to the revenue increase. For the operation profits, we move from 125,000 to 180. And for the income, and this is due to the high level of increase of gross profits, of course. And in this last year we had zero other income. Here we have 10,000. That means that the company, they had new source of income, not direct related to the business of the company. Then we have net income before taxes, 180,000. The last year it was 125. There is an increase of 52. This significant increase shows that the company is becoming more profitable, and overall, this is a strong indicator that the business is growing efficiently and well managed. We have a percentage of EBIT of 33%, while it was only 25% in the last year. This is a strong indicator for the growth and the increase of profitability for the company. For the net income for the company, here we have corporate tax. It was 13,000, and this year is 20,000. Of course, due to the increase of profit for this year. And we have net income for the year of 170,000. The last year it was 111. So there is an increase of 52%. The gross margin for the current year is 29, while it was 22 in the last year. So this increase of net income reflects strong overall profitability. The improvement in the net income margin from 22 to 29% demonstrate that the company is generating more profit for each dollar of sales, which shows strong profitability. The company should consider investing some of this income into growth initiative like R&D or new market entry to continue its upward trajectory. The growing of returning earnings with strong the equity position. We have seen 170,000 was added only this year in the returning earning, which improving the company balance sheet and give more flexibility to find future growth or whether economic down. So from those two financial statements, we understand that the company has demonstrated a robust growth across financial metrics, including revenue, gross profit, operational profit, and net income. Its ability to control costs while growing revenue is testament to strong management and operation efficiency. The balance sheet is solid with a good liquidity, 240,000, and manageable debt level, setting the company up to continue for success. Looking ahead, the company should continuously optimizing their cost of sales and operation expenses to maintain profitability. They should work on the account receivable to reduce that amount, which is a little bit higher. It can be lower, especially if the company may face cash challenges or they want to invest if the company or the shareholder decide to pay dividends. So if they pay the total 170, so the cash may reduce if there will be delay for the account receivable. With this insight, you can make informed strategic decision with confidence. So if you find this video valuable, please hit the like button and share it with others who may benefit from this knowledge. Also be sure to subscribe to stay updated on more valuable content. Feel free to leave a comment below with your question or thoughts.